Now we'll come to IAS 23. What is IAS 23? IAS 23 is called borrowing cost. Very important standard for your day-to-day accounting as well as for exam purpose, because most of the company will have some or the other form of borrowing. Some companies have huge amount of borrowing. Lakhs of crores of rupees they have borrowed. Okay. The question will arise, what to do with this borrowing cost? Capitalize or charge to P&L account or defer? So in this standard, we will be discussing which borrowing cost to be capitalized and which borrowing cost to be charged to profit and loss account. This standard gives you only two options. One, capitalize. Two, charge to P&L account. There is no third option. There is no third option of deferment. Okay. Borrowing is an important component of cost of a company. A wrong treatment may affect the statement of profit and loss, that is your performance, as well as the statement of financial position, right? Because the total value of your asset can be different if you rightly or wrongly apply this standard. Borrowing cost which should be capitalized, suppose, is charged to statement of profit and loss. Profit will be lower. Reverse also, it should have been capitalized or it should have been charged to P&L account, but you have capitalized, your profit will be overstated. So this standard will guide you with respect to that. An entity may incur borrowing cost in relation to acquisition, construction or production of an asset. There may be certain borrowing cost that need to be capitalized and others which needs to be expensed off. So this is the theme of this chapter. Which borrowing cost needs to be capitalized and which borrowing cost needs to be expensed off. So after understanding this chapter, you will be able to identify which borrowing cost and how much borrowing cost to be capitalized and how much borrowing cost to be expended, so that this will give a proper presentation of fair presentation of your SOPL and statement of financial position, SOFP. IAS 23 provides for the borrowing cost that needs to be capitalized and that needs to be expensed off. So first you come to the scope paragraph. This standard is to be applied for accounting of borrowing cost. So the only scope of this standard is how to account for borrowing cost, and of course at the end disclosures about borrowing cost. This standard does not deal with actual or imputed cost of equity. Actual cost means dividend paid. Imputed cost means notional cost. Okay, because equity may have an opportunity cost. So the standard says we will not deal with actual or imputed cost of equity, including that portion of preference share capital which is not classified as a liability. In IFRS 9 or Ind AS 32, you will learn that preference share can have two classification. Preference share can be a liability and preference share can be equity. If preference share is classified as equity, then the standard is not applicable. But if preference share is classified as liability as per IAS 32, then the standard is applicable. Is it right? When can preference share be classified as liability or equity? You will learn in detail in IAS 32. If there is an obligation to pay, liability, but if there is no obligation to pay, then it is equity. So preference share can be equity or liability. Accordingly, you give the treatment of any preference dividend that you pay. Normally Irredeemable preference share may be classified as equity normally, but more about this we will study in our standard on financial instrument. An entity is not required to apply the standard to borrowing cost directly attributable to acquisition, construction, or production of a qualifying asset measured at fair value. So this is another area where the standard is not applicable. Qualifying asset. What is a qualifying asset? We have not yet discussed. For the time being, it means an asset which takes substantial period of time to get ready for its intended use or sale. Okay. So if a qualifying asset may be a qualifying asset which is measured at fair value, like for example a biological asset, this standard is not applicable if it is measured at fair value. Okay. Inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. So the standard is not applicable to those type of inventories which are manufactured or produced in large quantity on a repetitive basis. Repetitive basis means that is the nature of their business. Continuously there is a production. So in that case, the standard is not applicable. Inventories which are manufactured or otherwise produced in large quantities on a repetitive basis, the standard is not applicable. So if a company is manufacturing say biscuits, daily 3 lakh biscuits are manufactured, is the standard applicable? No, because it is not a qualifying asset. After the scope paragraph, now come to definition part. This standard has 2 definitions only, but both are very important definitions. One is what is borrowing cost, and second, what is a qualifying asset. So borrowing cost means interest and other cost. Normally borrowing cost means interest, but the standard does not restrict itself to only interest. It says any other cost that are incurred by an entity in connection with the borrowing of funds. Underline, in connection with the borrowing of funds. So if it is not in connection with the borrowing of the fund, then it is not a borrowing cost as per this standard. And then the standard will not be applicable. For example, interest paid for delayed payment of tax. Interest paid for delayed payment of tax. Since you are a student of taxation also, if you do not pay the advance tax on time, do we pay interest? Yes. If you don't file your tax return on time, do you pay interest? Yes. Similarly, if you don't pay GST on time, do you pay interest? Don't submit TDS collected from different parties on time, do you pay interest? Yes. So this interest paid is not in connection with the borrowing of funds. So even though it is interest, but it is not in connection with borrowing of fund, the standard is not applicable. Okay. Now we'll talk about one other cost. Prepayment fees. Prepayment fees means you have borrowed money for 10 years. But then after 6 years, you decided to repay the loan. So generally what these banks do, in case you prepay the loan, they will charge you a prepayment fees. They will charge you a prepayment fees. The institute had given an opinion some years ago on this point. that prepayment fees is not in connection with borrowing of funds. Is it right? It is in connection with repayment of borrowing. So therefore, although here it is other costs related to borrowing, but it is not in connection with the borrowing, it is in connection with repayment of borrowing. And therefore, there is an opinion here which says it is not a borrowing cost. Okay. Now next is, what is a qualifying asset? The basic principle of this chapter, as you know, is borrowing cost incurred on a qualifying asset will be capitalized. The principle of this chapter is borrowing cost incurred in connection with acquisition, construction or production of a qualifying asset will be capitalized. So my question is, what is a qualifying asset? Qualifying asset, as per the standard, is an asset. Now it should have all the attributes of an asset. What do you mean by an asset? An asset is a resource controlled by an entity from which future economic benefit will arise, arising out of past event. This is a definition of asset. So this condition must be fulfilled first of all. Then only we can think about capitalization. That necessarily takes substantial period of time. Now substantial period of time would usually mean 12 months, but less than that is also allowed. If you can prove that this loan has been taken for the construction of a certain qualifying asset and it took about 8 months, 9 months to complete, then also practically you can capitalize those borrowing costs. If you can prove that it necessarily takes substantial period of time. Now what do you mean by necessarily takes? Necessarily, that is, it is in the nature of that asset that it is going to take substantial period of time. Like for example, you have to construct a bridge or a dam or a power plant or a factory or a building or a ship. Look at this example. These are such assets which you cannot make them ready for intended use in few days or few weeks. Okay. It is inherent in the nature of these assets that they are bound to take substantial period of time, few months to few years, mostly years, not just months. But now because of technology, you can do things much faster. Is it right? Still, they take substantial period of time. But suppose you have to manufacture a table on which you are sitting, and the contractor took 2 years to complete this table. He comes one day and then he comes after 6 months. Again he puts one more nail, again after 6 months. Theoretically, will this table be a qualifying asset? The answer is no, because it is not in the nature of this table to take 2 years to complete. You are delaying purposefully, right? So here it is going to take, here it is purposefully you have delayed, so this will not be a qualifying asset, right? So that is why they have used the word necessarily. Otherwise the company may delay some construction, and instead of charging the expense to P&L account, they may capitalize it. So necessarily takes substantial period of time. Substantial means usually 1 year. However, shorter or longer period can be justified. Shorter or longer period can be justified. Shorter or longer period can be justified. So remember shorter period, at least for exam purpose. I have seen so many exam questions. There they give only 6 months time period, 9 months time period for completion. And they ask the question how much borrowing cost will be capitalized. Now, some student can take a stand that this does not take substantial period of time. It is not a qualifying asset. All interest should be charged to profit and loss. But don't do that in the exam at least. Okay, because in the exam, the institute suggested answers have always taken it as qualifying asset, even though the total time period required was less than 12 months. So if you think that there is a qualifying asset, and you borrowed money to get it ready for its intended use or sale, then it is a qualifying asset. Now, what is the difference between intended use or sale? Here you are going to construct it, produce it, or acquire it for your own use. So it will be mostly classified as property, plant, equipment or intangible asset. Okay. Or sale means after producing it or manufacturing it, you are going to sell it. So which qualifying asset takes substantial period of time before it is ready to be sold? Inventory item. Is it right? Inventory. Okay, so which inventory? Does this pen take substantial period of time? No. It is produced in large quantity on repetitive basis. So there are some inventory, like mostly what I understand, liquor. Okay, wines. Because they will have to store it for some years in special storage facilities, and then the wine will mature and it can be sold. Okay. Now, what are the borrowing cost as per IAS 23? As per IAS 23, there are three items to be included in borrowing cost. 3 items only. What are these 3 items? Keep in mind. Interest expense calculated using effective interest rate method. Now, what do you mean by effective interest rate? It means in finance we call it internal rate of return. Internal rate of return, IRR. That rate of discount at which present value of cash inflow is equal to present value of cash outflow. This is the rate of return or rate of interest inbuilt into your cash flow system. Okay. Which standard talks about effective interest rate? IFRS 9. Now here some certain things we need to discuss. Student will ask, what about discount? What about premium on issue? What about premium on redemption? What about processing fees? What about legal expenses, stamp duty, ancillary cost, incidental cost, commitment charges? These are also incurred in connection with borrowing of funds. Is it right? But what about these? These all will get merged in effective interest rate. So when you will calculate the effective interest rate, all this will be considered. All this will be considered. For example, if you have issued the debenture at a discount, your effective interest rate will become higher than your nominal interest rate. Or if you have to redeem the debenture at a premium, your effective rate will become higher if you issue debenture at a premium, your effective rate would be lower. If you incur all these expenses will be considered in the calculation of effective interest rate, and therefore, even though not mentioned directly about all these other costs incurred in connection with borrowing, but they are indirectly included in the calculation of effective interest rate. Okay. So first is interest, which will include all the other ancillary incidental costs associated with borrowing. Next is finance charge. Finance charge in respect of asset acquired under finance lease. Actually, finance charge is also a form of interest only. About finance lease, you will study in another standard. That is basically, these are long-term leases where the installment paid to the lessor is not like rental, but more like a bank installment, which includes some interest portion. And the third is exchange difference arising from foreign currency borrowing, to the extent they are regarded as an adjustment to interest cost. Now let me explain this first. If you have to borrow from India or USA, in India the interest rate is 12%. In USA it is 4%. Okay, in USA it is 4%. You will borrow from USA. Is it that simple? Every company would have borrowed from USA only. Why will you pay 8% more? So it is found that a country which has low interest rate, its currency appreciate. So which currency will appreciate here? Dollar will appreciate. There is a theory in finance called interest rate parity theorem. This interest rate parity theorem says that if a country has low interest rate, its currency would appreciate. IRPT. I hope you have studied in financial management subject. If not, doesn't matter. It means if a country has lower interest rate, its currency would appreciate. Means dollar would appreciate in our example. Dollar will appreciate means rupee will depreciate. So the benefit of low cost interest in USA will be set off by exchange loss. Because when you will repay the loan, you will repay at a higher rate. Suppose today what we call spot rate is 70 rupees per dollar. 1 year later, it may become 75 rupees per dollar. So at the time of borrowing, you will get 70 rupees per dollar. But at the time of repayment, you will pay 75 rupees per dollar. So therefore, there is an exchange loss. Whatever is that amount. The standard says, why this exchange loss you are bearing? Because you have borrowed in foreign currency. Is it right? So therefore, exchange difference arising from foreign currency borrowing, to the extent they are regarded as an adjustment to interest cost. That means to the extent you have saved the interest. Up to that extent, it will also be treated as borrowing cost. More than that is your exchange loss, and that will give treatment under IAS 21. But up to the interest saved because of low rate of interest, it will be treated as exchange difference or exchange loss, and this portion of exchange loss will also be treated as borrowing cost. Okay. Now first you write down one very small example on how to calculate the effective interest rate. Then we'll take example on exchange difference. Generally in the exam, you will be supplied with effective interest rate if it is a question on IAS 23 generally. Okay, so take that rate for all calculation purpose, not the coupon rate or the contractual rate. Okay, still one small example will solve. ASF Limited took a loan of rupees 1 million. Processing fees paid rupees 20,000. Agreed interest rate is equal to 10% per annum paid annually. Loan is repaid. At the end of third year. Loan is repaid at the end of third year. Okay, just like I have taken processing fees here, your institute can give you some more cost, legal fees, stamp duty, charges, okay, registration of charges. So all this will have same number. So I have taken just one thing. They can give you 5 more item of expenses that you incur at the time of borrowing of funds. Okay, all this you put here, and this is the coupon rate. Time is 3 year. Calculate effective interest rate, EIR, in bracket that is IRR. So write down heading calculation of effective interest rate. Calculation of effective interest rate. So remember those happy days of financial management. Yes or no? Happy days when your teacher used to give you many examples on effective interest rate. So first we will make a list of cash flow, inflows and outflows. Year cash flows, and then we will assume a discount rate at which PV of cash inflow will be equal to present value of cash outflow. So discounting factor at the rate of, under that 2 column, discounting factor, present value, and then we'll take one more rate, a higher rate, depending upon whether we get positive or negative net present value, discounting factor at the rate of. So identify the cash flows. Okay, year 0, we took a loan of 1 million, but the processing fees paid is 20,000. So what is the net cash flow? 10 lakh minus 20,000. Is it right? Is it 9,80,000? You put this number in bracket, doesn't matter. And for 1-3, you are going to pay 10% of 1 million, so 1 lakh. And in the third year, you are going to repay 10 million. Normally, our calculation will be easier if I present outflow followed by inflow. You can also present inflow followed by outflow. Ultimately, IRR will be the same. PV of cash inflow will be equal to PV of cash outflow. Okay. Solve. Now just quickly guess whether your answer will be more than 10% or less than 10%. It will be little more than 10% because you had incurred 20,000 rupees as processing fees also. So what I'll do, I'll first start with 10% and then I will increase the rate by 1 or 2%. So tell me the factor of 1-3. 1 upon 1.10, 3 times equal to GT 2.4868. And only third year factor will be 0.7513. Multiply 9,80,000 in bracket. This will be 24868. This will be 751300. Is it right? Now tell me, dear student, what is the net amount after deducting 9,80,000? Yes. $19,994. Positive or negative? Positive. Just check everyone. Is it positive? Hello? Positive. Check the total, everything again. Now take 11% because we are very close to 0. 11 or 12% you will take. Now factor is 1. You can take 11, 12, 13, 14, doesn't matter. Now what about the annuity factor for 1-3? 1 upon 1.11 equal to, then press GT. If your calculator does not have GT function, 1 upon 1.11 equal to M plus 3 times and then MRC. Yes, anybody? 443? Very good. Third year factor only. 70? 73? 73? 12? 7312. Okay. Okay, once again, just help me. 9,80,000. 1 lakh into this number is 24437. 10 lakh into this number 7,31,200. Is it right? 24437 is right. This is 1 lakh. This is 0. Okay, so here also it was 0. So no problem. Tell me the answer approximately. One five. Positive or negative? Again positive. Let me also try. 244,370 plus 731,200 minus 9,80,000. I think it is negative. What is the answer finally? Try again. I request you to try again. What is your answer? Last one. 4430 negative you are getting? No, negative. Doesn't matter. Your answer should be same because PV of cash inflow will be equal to PV of cash outflow. Okay, now you have got one positive, one negative. So your EIR will be equal to, first it means if you have written the cash flow in this fashion, it means your IRR is somewhere between 10 and 11. At 10% it is positive, at 11% it is negative. We want to reach 0 so that PV of cash inflow and outflow will be equal. So it is 10 plus NPV at lower discount rate 19994 upon the difference between the two NPV 19994 plus 4430 into difference between the two rates 11 minus 10. This formula is taught in basic financial management subject. It is a formula of interpolation. To solve it now, anybody wants to answer? Haji? Yes. Is it around 10.82%? 81 or 82%? Yes. This is called effective interest rate. This will be used for the purpose of calculating the interest. So in the first year, interest as per IAS 23 will be equal to 10.82% of which number? 9 lakh 80,000, not 10 lakh. 10.82% of the net amount, 9 lakh 80,000. How much is that? 10.82% of 9 lakh 80,000. Is it around 106036? This is the interest that you will consider in the first year as borrowing cost. Okay. Second year figure will change. But that is not our discussion right now. Don't worry. Okay. More about this interest calculation you will learn in IFRS 9 and IAS 32. Okay. Have you noted the example? So in your exam, as I said, repeat, EIR will be given to you for every borrowing. If not given, then you will have to calculate like this. Is it right? First, in year 0, you write whatever cash inflow or outflow that has taken place, taking into account any other discount, premium, processing fees, legal fees, etc. You can either do the calculation from lender's point of view or from borrower's point of view, because the answer will be the same, whichever way you are comfortable. Now we'll talk about the exchange difference to the extent regarded as an adjustment to interest cost. So this is your example printed in the note, problem 1. No need to write. Problem 1, just I have written the main numbers. Company borrows $20,000 at rupees 45 on 1/4/2016. In USA, the interest rate is 6% per annum. Then on 31st March 17, after a year, the interest rate is 48 rupees. So the exchange rate is 48 rupees. Local interest rate, what is local interest rate? If you would have borrowed in India, then you would have paid only 12%. What is the total borrowing cost? What is the total borrowing cost? Is it right? How will you calculate the total borrowing cost? One borrowing cost will be, answer is printed in your note. So no need to write, just understand on the screen. One is the interest actually you are going to pay. Interest paid. You have borrowed how much? $20,000. And you have to pay 6%. So to the foreign lender, you will pay 20,000 into 6%. When will you pay? Today or after a year? So after a year, you need $1,200 to pay interest. So when you convert $1,200 to repay the interest, you will have to convert it at the rate of 48 rupees because interest will be paid at the end. So will you calculate and tell me how much interest you are actually going to pay? 57,600 rupees. Okay. Now my next question is exchange difference. To the extent regarded as adjustment to interest. You have borrowed in foreign currency because the interest rate was low. Okay. But there is a disadvantage. As I've told you, generally it is found that if you have a lower interest rate in that currency, it will appreciate. Okay. And the logic for that is that otherwise everybody will go to that country only and borrow money. But by the time you start bringing the money or repaying the money, the exchange rate would have gone up. Now, how to calculate this? For this, first I will calculate how much is my exchange loss. You borrowed $20,000 when the rate was 45. At the end of the year, the rate is 48. So 3 rupees per dollar is your exchange loss. 48 minus 45 into 20,000. 60,000 rupees is your exchange loss. This much you can do. And then you have to calculate how much interest you have saved. How much interest you have saved. By borrowing in foreign currency, interest saved. So interest saved, how do you compute interest saved? I would have borrowed in rupee borrowing. I needed how much rupee today? 20,000 into 45. I would have borrowed 9 lakh, which is equivalent to $20,000. And interest on rupee borrowing would have been 9 lakh into 12%. So that is 1 lakh 8,000 rupees. Right. Now you will understand. Had you borrowed in rupee, you would have paid 1 lakh 8,000 interest. By borrowing in foreign currency, you have paid only 57,600 rupees as interest. So what is the interest saved? Therefore, interest saved will be 1 lakh 8,000 minus 57,600. Calculate 50,400. This is my interest saved. But in the process, you had suffered a loss of 60,000 on exchange loss. So now what the standard says, exchange difference to the extent regarded as adjustment to interest cost. So how much is the exchange difference that will be treated as interest cost? 50,400. Okay. So point number C, exchange difference to be treated as borrowed cost. Will be 50,400. Okay. And what is the total interest cost, total borrowing cost? So total borrowing cost will be one. As we discussed, there are three things in borrowing cost. Interest 57,600. Finance charges under finance lease nil. And exchange difference to the extent of interest saved 50,400. So my borrowing cost as per this standard in this example will be 1 lakh 8,000 rupees. Is it right? Is it coming to 1,08,000? No. Yes. But your exchange loss is only 60,000. You have only treated this much as borrowing cost. So what about the remaining exchange loss? Remaining exchange loss 60,000 minus 50,400 will be given treatment as per IAS 21. Will be given treatment as per IAS 21, which normally would be your profit and loss. Okay. But about exchange loss statement, we have to go to IAS 21. One more example we'll take. This example we have written. Example 2. There are three situations. 1 and 2 I will solve. Please note down situation 3 as homework. Okay. What is the change you will observe on the screen right now? Only one change I have done. The local interest rate I have made it 14% instead of 12% now. So some numbers we will repeat. For example, what is the actual interest paid? Same figure. Tell me actual interest paid. 20,000 into 6% into 48. 57. 600. Is it right? Second, exchange loss. Same figure. Exchange loss total 48 minus 45 into 20,000. Answer is printed. Pay attention on understanding. All figures in the corner is in rupees 60,000. Next is interest on local borrowing. How much interest you would have paid had you borrowed in local currency? You need to borrow 20,000 into 45 and then your interest rate is 14%. So that comes to how much? 1,26,000. So how much is your interest saved? 1,26,000 you would have paid in India, but you pay only 57,600 there. So interest saved is 68,400. Now understand with the help of this just diagram. Exchange difference is 60,000. Interest saved is 68,400. In this example, exchange difference is less than interest saved. So the standard says exchange difference up to 68,400. Up to which amount? Up to 68,400 will be treated as borrowing cost. So this entire 60,000 will be treated as borrowing cost. And this is interest cost. So again my calculation, if they ask you what is total borrowing cost, sum of the three numbers. One is interest, finance charge under finance lease which is not there, exchange difference to the extent regarded as adjustment to interest cost. So my answer is 117,600. Okay. Then one question which students should not ask but sometimes they ask. What about the remaining interest saved of 8,400? What will you do? Nothing. Why nothing? When I say nothing, he is further confused. Because this is a notional number. This calculation is a notional, means it is not in the books of account. It is outside the books of account. This ledger account does not exist in our book. This entry is never passed in our books. It is only we are thinking, had I borrowed in India, how much I would have paid, how much I would have saved. Which two numbers only appear in our books of account? One is the actual interest you are going to pay and the exchange difference, and both of these you have added as borrowing cost. So nothing to be done with that 8,400. Okay. Now note down one homework, situation 3 as homework. Come to next paragraph 5. Examples of qualifying assets. Examples of qualifying asset. Qualifying assets are those assets which necessarily take substantial period of time to get ready for its intended use or sell. So some examples are manufacturing plants, intangible assets, power generation facilities, investment properties. Also IAS 40. Which standard? Right in bracket IAS 40. And some category of inventory, some inventory, not all inventory, those which take substantial period of time to get ready for its intended use or sell. Okay. And what is not a qualifying asset? Not a qualifying asset. Assets that are ready for intended use or sell when acquired. Now, this is an important thing. Sometimes in the exam they have asked a question like this. You have purchased an aircraft. It's an expensive asset. You borrowed 30 crore rupees borrowing. You paid 3 crore as borrowing cost or interest. Explain the treatment of borrowing cost. So if you have purchased the aircraft, motor car, ship, which is in the ready to use condition when you have acquired, then you are going to charge that interest to profit and loss statement. Okay. So because this is not a qualifying asset, the basic principle keep in mind, borrowing cost relating to acquisition, construction or production of a qualifying asset can only be capitalized. Now what is the logic of not capitalizing this interest cost? Because you have purchased this aircraft which is in the ready to use condition. The seller, the one who has sold you this aircraft, he might have already considered his financing cost in determining the selling price. But when you construct something, you borrow money to construct that asset. Had you purchased it in a ready to use condition, the seller would have included his financing cost in the price determination. So therefore that is the logic of this entire chapter, that when you buy something in a ready to use condition, the seller has already considered his financing cost. But when you are constructing and you have borrowed money for that purpose, you have to add it. Right. Second is those inventories that are routinely manufactured. Which are routinely manufactured means every day you manufacture this item. Like for example, this pen only, biscuit only, this calculator also. Is it right? This mobile phone also. These are all routinely manufactured. Samsung company, every day they manufacture lakhs of mobile phone. Okay. Or otherwise produced in large quantity on a repetitive basis over a short period of time. Then these are not qualifying asset. Which are produced in large quantities on a repetitive basis over a short period of time. Which means only those inventories which take substantial period of time to get ready for its intended use will be capitalized. And then the third is financial assets. They have asked a question on this point also. You have borrowed money to buy investment. You have borrowed money to purchase investment in shares. Company wants to capitalize the borrowing cost over the cost of investment. Allowed or not allowed? Not allowed, because financial asset is not a qualifying asset. Does it take substantial period of time to get ready for its intended use or sale? No. So mostly what will come under this standard is the property, plant and equipment items which the company is acquiring, constructing or manufacturing, or some intangible asset also, and some inventory may also come here like wines, but otherwise most other item will not come under qualifying asset. Now suppose we have proved that it is a qualifying asset. Okay. Suppose we have proved that we have taken funds for qualifying asset. Still check certain more aspect before you actually capitalize it. Okay. For the borrowing cost to be eligible for capitalization, the following conditions are to be noted. This is the main principle of this chapter. Borrowing cost which are directly attributable to the acquisition, construction or production of a qualifying asset are to be capitalized. That's it. But then there are a lot of terms they have used here. Borrowing cost, which we have seen. Directly attributable. What do you mean by directly attributable? Funds are taken for that purpose. Is it necessary to prove that this loan is taken for this asset? Yes. No. You have to just see that if my qualifying asset would not have been there, the level of borrowing would have been lower. Many times we do not take specific loan for specific qualifying asset. Like for example, a company is there, A Limited. It has issued 14% debenture, 11% loan, 6% foreign currency loan. So all this money will first come to the bank account of the company. Is it right? And from this they will incur expenditure on qualifying asset 1, qualifying asset 2, working capital, etc. Do we know which loan has gone where? Sometimes it is not possible to know that. If you have raised the funds in general and then use it for many purposes, you may use it for qualifying asset, you may not use it for qualifying asset, you may use it for just working capital. But I have to now check whether these loans are directly attributable to these qualifying assets or not. How do I check? I will think, now this will involve some degree of judgment. If this qualifying asset were not there, if these qualifying assets were not there, suppose the company did not have this qualifying asset, will my level of borrowing still be the same or it would have been lower? So two answers are there. You will say, even if these qualifying assets were not there, my level of borrowing would have remained the same. Then the borrowing is not directly attributable to qualifying asset. But if you say that because there is a qualifying asset, my level of loan is on a higher side, and in that case you can say that it is directly attributable to qualifying asset. In case of specific borrowing, this problem will not arise. But in case of general borrowing, this issue may arise. Management will have to demonstrate that our level of borrowing would have been lower if we would not have that qualifying asset. Borrowing cost, so qualifying asset or the borrowing cost that could have been avoided if the expenditure on qualifying asset had not been made. So this line is a further explanation of this point, directly attributable, that my borrowing level would have been lower had I not incurred expenditure on qualifying asset. So first principle is borrowing cost must be directly attributable on acquisition, construction and production of a qualifying asset. This nexus I have to prove. Second thing I have to prove that qualifying asset would generate future economic benefit to the enterprise. There may be a qualifying asset by definition, but it may not generate future economic benefit to the enterprise. How? Company constructs a school building. Is a school building qualifying asset? Qualifying asset is an asset that necessarily takes substantial period of time to get ready for its intended use. So you took 1 year and you constructed a school building in a remote village. And then it is a part of your CSR expenditure. Okay. Under CSR expenditure, you constructed a school building, you constructed a canal, whatever, road. First of all, this will not be capitalized as an asset in our book only. Is it right? This will be charged as expenditure because you're not going to get any benefit. And if you have borrowed any money for that purpose, that will also be charged as expense. For that time being, assume to begin with, then we'll change the example. Then the company says, oh, this is not a qualifying asset. I will construct a temple in the factory premise. Okay. Temple is also not a qualifying asset. Why? Temple takes a lot of time to construct. But sometimes they capitalize temple also. So temple is suppose capitalized in their books, but temple is not going to generate any future economic benefit. Charge to P&L account all borrowing costs associated with that. So these are just examples. So similar any such example on which you incur temple. People ask this question to me. Some people say that temple will generate economic benefit to the enterprise. How? They will generate donation. No, people will feel little calm, quiet, peace of mind. Their efficiency will increase. Okay. That is how they say. So you may capitalize the temple building in your books, but any borrowing cost don't allow them to capitalize. Temple building is a qualifying asset because you can sell it and you will get some money out of it. Now next is our topic starts actually now. How to do calculation of borrowing cost, right? And how much borrowing cost will be capitalized? Two calculation. First is understand from the question whether it is a specific borrowing or whether it is a general purpose borrowing. Once you find that it is specific borrowing, then your task is actually very easy. Specific borrowing, what you will do, calculate the borrowing cost and capitalize it over that specific asset. Calculate the borrowing cost and capitalize it over that specific asset. How will you calculate? Use the effective interest rate method. Use the effective interest rate method that we have learned. Don't forget that. So in case of specific borrowing, capitalization rate should be the actual borrowing cost incurred using effective interest rate method. Okay. In case of specific borrowing, one more provision is applicable. You have taken loan, okay, 500 million, but you're not going to use the entire loan on the day one itself. The loan amount is spent over 1 year period on the construction work. In the meantime, you have invested some surplus money in a temporary investment. So instead of keeping the funds idle, why not to invest in some government bond, FD, etc. Okay. And you earned 5 million interest on this. And on this loan, you paid 50 million interest. The standard says, while capitalizing the borrowing cost, in this case, the interest earned or income earned, I am not using the word interest, income, it can be some dividend also. Interest plus dividend or anything that you have earned from temporary investment of that borrowed amount will be deducted from the actual borrowing cost incurred. So only 45. Now here the question in the exam comes, a company took a specific loan, it parked temporary surplus, it earned 5 million, company showed that as other income in the statement of profit and loss. Then you have to know this provision. It cannot do that. It has to reduce it from the borrowing cost incurred. Then some student have asked this funny question also. Your borrowing cost incurred is 50. Investment income is 55. Possible? Possible. It's not impossible. It is possible. You are a better investor. So this 5. Now what to do with this 5? This will go to income. Or should it be treated as a negative borrowing cost and reduce the cost of the qualifying asset? Income. Actually, the standard is silent. No standard, whether it is Ind AS, AS or IAS, they have discussed this possibility because they think that this is a rare possibility, but this is not impossible. It is rare but not impossible. For example, company like Reliance Industries Limited, they have a goodwill in the market. They raise funds at around 4 to 5% interest rate because they have so much of reputation, and they invest around 6 to 7% or 8% interest also. That is what they do. One of their major source of income in their balance sheet is interest income. Other income contains some thousands of crores of rupees as interest income only. Now they can do this, but they have a huge reputation in the market where they can borrow at a much lower rate and they can invest it, and they just make the difference between this 2-3% as their income. But not every company is Reliance. Okay. Second thing, you will not be able to invest the entire amount because you are going to use it for construction purpose. Out of 500 million, you are not going to invest entire 500 million. You may invest 100, 200 million. So that will not generate interest income more than the interest you have to pay. Third thing, interest income is usually lower than the interest expense. Banks usually charge you more interest and pay you less interest. If it was so easy, then your business model should have been changed. Okay, so it doesn't happen. Now we'll solve few simple questions on this. Very simple. Each question will take 30 seconds to answer. Start. Question number 4 below. The company borrows for investment in power plant. Since presently there is a requirement for only 50% of the money raised, and the balance will be required after 6 months of year 1. The company invested such funds temporarily for 6 months at 4% per annum. Borrowing cost for 1 year as per amortized cost method means effective interest rate method. Amortized cost method means effective interest rate method. Good news, they have done the calculation. Is 1015.51, investment income 99.05. Okay, what is the borrowing cost you are going to capitalize as per IAS 23? You just have to take the difference, that's it. Okay, check the calculation. Is it right? So you will say that temporary income will be reduced from the borrowing cost. But only if you have studied this chapter, you will be able to answer. Next question. This may come as a part of a longer question. Under IAS 16, we had solved a problem. Under IAS 16, we have solved a problem whereby you are given the same example with temporary income also. So this small question will become part of a bigger question where you have to calculate the total cost of property, plant, equipment. Once again, next question. 30 seconds only. Rainbow Limited borrowed an amount of 150 crore for construction of boiler plant at 11%. The plant is expected to be completed in 4 years. Weighted average cost of capital is 13% per annum. The accountant of Rainbow Limited capitalized rupees 19.50 crore for the accounting period ending on 31st March 2009. Due to surplus fund out of 150 crore, an income of 3.50 crore was earned and credited to P&L account. Nalayak. Useless. Comment on the above treatment with reference to relevant standard. So the answer is the company should not have credited the income to statement of profit and loss. Income from temporary investment should have been reduced from the borrowing cost incurred. So the net borrowing cost to be capitalized is 16.50 minus 3.50, that is 13. Is it right? Check the calculation, it is given in the notes. Is it 16.5 minus 3.50, 13? Okay, try this question number 15, which is also printed towards the end of this chapter. AS Limited borrowed rupees 12 crore. Is it there? No, this is not 15 number. Some other number. Find out this question. AS Limited borrowed rupees 12 crore for its capital expansion, which lasted 18 months. What is the number? The relevant borrowing rate, this is 14 actually. The relevant borrowing rate was 12.5%. Calculate 12 into 12.5%. During this period, the company invested the temporary surplus funds at 4.5% and earned interest of 25 lakh and offered as miscellaneous income in the P&L account. Very wrong. Company has capitalized the entire interest cost and added to its plant and machinery. Is this correct? No. So how many months they have taken to do this entire construction work? 18 months. So first you have to calculate the borrowing cost incurred. 12 into 12.5% into 18 by 12. How much it comes to? 2.25. And then from that you deduct the income from temporary investment 0.25. Remaining amount will be treated as borrowing cost. Okay. And then you will write a note also that crediting rupees 0.25 crore to SOPL as miscellaneous income is not proper. The amount should be used to reduce the borrowing cost eligible for capitalization. Okay. Now the next is borrowing cost eligible for capitalization. General purpose borrowing. General purpose borrowing means there is no direct nexus between the borrowing and the qualifying asset, but the borrowing is attributable to qualifying asset. I had given one example, I repeat again, that you may have taken 15% loan from SBI, State Bank of India. You may have issued a 16% debenture. You may have issued foreign currency loan at 6%. All this money will come to your bank account from different sources, and then out of this you incur expenditure. Some may be on a qualifying asset 1, qualifying asset 2. Some may be on a ready to use asset, not a qualifying asset, okay, but an asset ready to use. Some amount may be used for working capital. Some amount may be investment. Just example. But one thing is sure, that the level of borrowing would have been lower, the qualifying asset would not have been there. But I don't know which loan has gone for which qualifying asset. So in this case, what we do, we calculate what is known as capitalization rate or weighted average borrowing rate. So in such cases, what we'll do, we'll calculate the weighted average borrowing cost. Okay. How to calculate the weighted average borrowing cost? Write one small example. Calculate weighted average borrowing rate. Okay. Date of loan, loan amount, effective interest rate. Year end. So date of loan 1/4/19, loan amount 20 million, effective interest rate you have to take. Okay, so I'm giving you directly in the exam. Be careful, they may give you two rate of interest rate and effective interest rate. So you have to take effective interest rate. Year ending date 31st March 20, and same 1/4/19, 40 million, 12%. Year ending date is 31st March 2020. First I'll take this simple example. Okay, now how to solve the problem? First you calculate the borrowing cost. Now these are general borrowing cost. So borrowing cost in this example is very easy. Can you see this loan is outstanding for entire 1 year period? So simply 20 into 11% plus 40 into 12%. Give me the final figure. 7. Sure. 7 is right. And then weighted average borrowing. Both the loans are outstanding for 1 full year. So 20 into 12 by 12, 40 into 12 by 12. Both are outstanding for 1 full year. You could have directly written 20 plus 40 also. So that is 60. So what is my average cost or weighted average cost? 7 by 60. 11.61%. So this will become the weighted average borrowing cost rate. Okay, this will become the weighted average borrowing cost rate. Now this rate you will use for calculating the borrowing cost to be capitalized over the qualifying asset. Is it right? This rate you will use to capitalize over the qualifying asset by multiplying this rate with the expenditure incurred on the qualifying asset. Now just change the example, right? Example 2. Example 2. Calculate weighted average borrowing rate. Calculate weighted average borrowing rate. Now only one small change I will do in the whole calculation. The date of second loan I'll make it 1/9/19. 1/9/19. Will my answer change? Yes. My borrowing cost first will change. It will be first 20 into 11%. This is for full year. This is 40 into 12%. Now how many months are there between 1/9/19 to 31st March 20? September, October, November, December. Okay. January, February, March. 7 months. Take 7 by 12. This number 7 by 12, 40 into 12% into 7 months divided by 12 months. 12% is per annum. Calculate. Interest, how much is that? Is it 5? 5. Weighted average borrowing. Now this time you be careful. 20 is outstanding for 12 months. So 20 by 12. And 40 also is outstanding for 7 months. 7 by 12. So that your numerator and denominator will match. If I take 40 for the entire year but interest only for 7 months, then numerator and denominator are not comparable. What is the answer? No, first you tell me 20 into 12 by 12, 40 into 7 by 12. How much is this figure? 43.33. Now average cost. 5 by 43.33. 11.5, 4%. Check the answer, right? So this is how we will calculate the weighted average borrowing cost for general purpose borrowing. Be careful, you have to use EIR, not the coupon rate or the contractual rate. If EIR is not given, we have discussed how to calculate the EIR. Okay. Okay, now we'll solve one small example. Okay. On application of weighted average borrowing cost. This is like a basic example, and many exam questions would be like this only. This example is printed there. Advise X Limited on the weighted average cost of borrowing and interest cost to be capitalized based on the following. Total borrowing and interest cost of X Limited for year ended 31st March 2005 are as follows. So there are 3 loans. One for 2004, one 10 2004, one 7 2004 in your notes. And the interest rates are also different. 18% bank loans, 14% debenture, and 16% term loan. These are the amounts, 1000, 2000, 3000. Now, one calculation is done for you. If it is not done for you, then you have to do it in the exam. Which is the calculation? Interest calculation. Just check, is it right or not? 18% into 1000. And the year ending date is 31st March. So 12 months into 12 by 12. Is it 180? In the exam, this column may not be given to you. I am generous. I am giving it to you. 14% into 2000 into 6 by 12. Is it 140? 16% into 3000 into 9 by 12. 360. 680. So one working note is done in the problem borrowing cost. And they have been taken at different point of time. So we'll have to prepare one weighted average borrowing. Weighted average borrowing amount. Now these 3 borrowings have been used for these 3 qualifying assets. Factory shed, plant 1, plant 2. And these are the expenditure incurred on this qualifying asset. And this is the period for which this construction, acquisition, production activity were in progress for the year. 12 months, 9 months and 7 months. So while calculating the borrowing cost, you will multiply the expenditure incurred into the time period divided by 12 months and into the weighted average borrowing rate that you will calculate. So what you do? First you write down step 1, weighted average borrowing. Weighted average borrowing. I will write here step 1. Actually in the exam this will be step 1 first, borrowing cost. But this is calculated for you. Weighted average borrowing will be equal to, see this 1000, and for how many months this is outstanding? 12 months into 12 by 12. Then take this 2000 into how many months this is outstanding? 6 months into 6 by 12. Then take this 3000. For how many months this is outstanding? 1st July to 31st March? 9 months. So give me the answer. Is it 4250? So this is average borrowing, and this is average or interest incurred. So what I'll do, I will write step number 2, weighted average borrowing rate. Write neatly, weighted average borrowing rate. Weighted average borrowing rate will be equal to 680 upon 4250. 680 upon 4250. How much? 16%, right? 16%. That means my average cost of borrowing is 16%. If nothing is given, you have to assume that there is a borrowing cost are directly attributable to qualifying asset. Okay. Now write down step 3. Ascertainment of borrowing cost to be capitalized. Ascertainment of borrowing cost to be capitalized. Write neatly. In professional exam, you get marks for better presentation also. Qualifying asset, expenditure, number of months, and borrowing cost to be capitalized. Qualifying asset, expenditure, number of months, borrowing cost to be capitalized. Qualifying assets are 3. Factory shed, 1 line blank. Plant 1, 1 line blank. Plant 2. Expenditure 2500, 1500, 1000. Number of months 12, 9 and 7. How do you compute this column? Use simple interest formula. 2500 into 12 by 12 into 16%. So that comes to 400. 1500 into 9 by 12 into 16%. 180. 1000 into 7 by 12 into 16% is 93.33. Right? Take total. 673.33. Correct? How much borrowing cost we have actually incurred? 680. And how much we are going to capitalize? 673.33. What about the remaining borrowing cost? So the remaining borrowing cost will be treated as expense. Below this, write down step number 4. Step number 4 is borrowing cost to be expensed. Borrowing cost to be expensed. Expense means you will charge to P&L account. Total borrowing cost minus borrowing cost to be capitalized. Total borrowing cost minus borrowing cost to be capitalized. Total borrowing cost 680 minus 673.33. How much it comes to? 6.67. So this will be charged to your profit and loss statement. Only one thing keep in mind. If the borrowing cost to be capitalized exceeds the actual borrowing cost incurred, then what we will do? We will restrict ourselves up to the actual borrowing cost incurred. Is it right? Now I'll go to the previous example. Suppose this total exceeds 680. If this total exceeds 680, you are not going to capitalize more than what you have incurred. Then what will you do? You have to reapportion that 680 over this 3 asset. In which ratio? In the ratio of this column only. For example, now you don't have to write, only for understanding, and then ignore whatever I am doing. First, suppose these figures are not there. Example sake. Let us say this is 450 this is 250, and say this is 100. So my total comes to 800, for example, because I can change the numbers by changing the number of months, right? So 800 you are getting, but my actual is only 680. I can't capitalize 800 when my actual borrowing is 680. So what you will do in this ratio, what is the ratio? 450, 250, 100. You will apportion 680. So take your calculator, 450 divided by 800. Okay, what is the answer? How much will come here? 380, 382.5. Then 250 into 250 in 250 divided by 800 into 680. How much? 212.5. 100 divided by 800 into 680. 85. And now if you cross check, the total is 680. Right? So this way you will do. Be very alert. If this total exceeds actual borrowing cost, then draw one more column and apportion immediately next to that in the same ratio of this fourth column. This problem will arise only in case of general borrowing. This problem will not arise in specific borrowing. In specific borrowing, whatever is your specific borrowing cost after deducting the income from temporary surplus will be fully capitalized over that specific asset. Okay. No calculation involved in specific borrowing. Just compute the borrowing cost minus temporary income, and that amount will be capitalized over that particular asset. Now next is commencement of capitalization. When should you start capitalization? Following three conditions have to be satisfied. Expenditure on qualifying asset is being incurred. Then borrowing costs are incurred. And the third is activity crucial for preparation of qualifying asset to its intended use or sale should be in progress. If these three conditions are satisfied, then you will capitalize the borrowing cost. Now, one question can be asked. Suppose I have taken a land on purchased a land and borrowing on 1419. Okay. And the construction activity may be started after say 1 month, 30th April 19. But during this period, what you are doing during this period? During this period, you must be involved in some administrative activities like getting the planned approval, getting an architect who will do all the planning, going to the municipality and getting your plan approval. Will that be also called as an activity crucial for preparation of the qualifying asset to its intended use or sale? Yes. So one question was there in your IAS 16. That day we had a question in IAS 16 that this is the date of borrowing, this is the date actual construction begins, and we had taken this date because we had assumed that the activities which are necessary to bring the qualifying asset have started working. So like for example, architect will come and do the planning, land leveling, approval or other administrative formalities. If they have started and land you have purchased, okay, that means your process has started, borrowing is there and this is there. When all three are satisfied on this date, you can start capitalizing from this date. But if nothing has been done between these two dates, zero activity, then interest of this 1 month period will be charged to profit and loss account. Huh? That was the assumption. because you have to write an assumption that activity which is crucial for preparation of QA to its intended use or sale should be in progress. Now there is an example printed there. An entity has incurred expenditure on the purchase of equipment for installing power plant. Very good. An incurred borrowing cost. So two conditions are satisfied. Expenditure on qualifying asset has been incurred and the borrowing is incurred. Third condition, but construction activity have not started by the end of the reporting period. That means those activity which are required to convert the QA into the finished goods or the asset which you intend to use is not yet started. So three conditions are there. Two are satisfied, one is not. Can the entity capitalize the related borrowing cost? The answer is no. Next is suspension of capitalization. Suspension of capitalization. When will you temporarily stop capitalization of borrowing cost? So tick mark this paragraph. Suspension of capitalization. Suspension means temporary stoppage. Temporary stoppage. And then we'll discuss permanent stoppage. Now the summary of that entire big paragraph is this much. Why your active development has been suspended. First is expenditure on qualifying assets should be incurred. That you have done. Borrowing you have taken. But then the third step is that you must continuously take all those steps which will convert your qualifying asset into the intended asset or the inventory item. You have suspended those activities. Identify the reason. The reason could be avoidable or unavoidable. Avoidable means these reasons could have been avoided. Like for example, lack of funds. You started the construction of a building, but then you ran out of money. So you have to temporarily stop the work. Okay. Or for example, workers strike. Is it avoidable or unavoidable reason? Avoidable. Unavoidable. Now, it is avoidable because you should maintain proper relationship with the worker. That could have been done. These are all man-made disasters, okay? Or there is some dispute started after you started the construction work. Some kind of dispute. These are called avoidable. These are not inherent in the nature of the prospective qualifying asset. So we have to say, is it inherent, is it natural, or is it man-made? Man-made. Man-made items are avoidable. Unavoidable reason example. For example, if you're constructing a building, then after doing that slab work, whatever you call it technically, I don't know, you just need to keep it as it is so that it will dry up and it will become stronger. Is it right? For a few days, we just leave the thing as it is. 15 days, you don't do anything. Or for example, you are manufacturing wines. That is a simple example. You complete all your basic process and then you just store it in a standard special storage facility. And you're not supposed to do anything for some years. That is unavoidable. Next is suppose you are constructing a bridge on a river. Water level have gone up due to excessive rain. So temporarily you have to stop the work. Is it right? These are unavoidable. So construction of a bridge on a river, water level going up, then storage for wine. Some days you have to just keep the building as it is because that is the process in construction. If it is avoidable punishment to you, you will suspend the capitalization of borrowing cost. But if it is unavoidable, then you will continue to capitalize the borrowing cost. Okay. So the question that they may ask in the exam, that during the year 1 month the active development was suspended due to avoidable reason. So while calculating the borrowing cost, suppose the total period is 12 months, remove 1 month and only do the calculation for 11 months. They may also say 1 month the work was suspended but it was unavoidable. Then ignore that information. You continue to capitalize the borrowing cost. So example of unavoidable reason printed in your note also. An entity does not normally suspend capitalization of borrowing cost during a period when it carries out substantial technical and administrative work. An entity also does not suspend capitalization of borrowing cost when a temporary delay is a necessary part of the process of getting an asset ready for its intended use or sell. Okay. So when such activities are necessarily the part of the process only, you will capitalize the borrowing cost. And one more practical example. Capitalization continues during the extended period that high water level delay the construction of a bridge, if such high water level are common during the construction period in the geographical region involved. Now on this point, suspension, we have a small example. I have tried to put one example for every concept. ABC Limited commenced construction of a flyover in Mumbai in January 2016 under BOLT scheme. BOLT means build, operate, lease, transfer. The same was completed in Feb 17. Very good. Due to heavy seasonal rain in July 16 in the area, the work on the flyover had to be suspended for a month. Company accordingly suspended the capitalization of borrowing cost of 12.5 lakh for that month. So what this company did, it also suspended the capitalization of borrowing cost. Is flyover a qualifying asset? Yes. Then the topic will move ahead. First, the asset has to be a qualifying asset. Expenditure on qualifying asset is incurred, borrowing cost is incurred. Is the company right in suspending the capitalization of borrowing cost? The answer is no. Okay. Capitalization of borrowing cost should be suspended during extended period when active development is interrupted. In the given case, it was mentioned that construction activity was interrupted a month due to seasonal rain. Though the rain was heavy, the period cannot be considered as extended period, leading to a substantial delay in the suspension of construction activity. The period can be considered as a temporary delay and hence eligible for capitalization purposes. So you have to say that companies should continue to capitalize the borrowing cost because the delay is unavoidable. Only this much you can write. Now, the next is cessation of capitalization. What do you mean by cessation of capitalization? Stoppage. Okay. Now, this is permanent stoppage. Thereafter, whatever borrowing costs you will incur will be recognized in statement of profit and loss. You have to also think, when will you stop capitalizing the borrowing cost on permanent basis? When the asset is ready. Ready or substantially ready? Why not fully ready? Some minor work may be pending. Okay. Suppose this is a stadium. Example only. Now this is a 50 crore rupee stadium. And this is the gate of that stadium. which will cost 2 lakh rupees to construct. Okay, whole stadium is ready, but this gate is not ready. Stadium was ready on 1/4/19. Gate was ready on 31st March 2025. What about the borrowing cost incurred during this period? Capitalize or charge to P&L account? P&L account. But gate is not ready. But this gate is not a very significant component because this whole asset is of 50 crore. In front of that, this small gate is about 2 lakh rupees. So therefore, the standard says capitalization should cease when substantially all activity. They are also careful in using the terminology substantially all. Otherwise, some company may say that the work is not yet complete, something is pending, and we will continue to capitalize the borrowing cost till this is also ready. In preparing for the QA for its intended use or sale are complete. Okay, like a building is constructed and then outer wall is not painted. This 20 storied building is constructed and this outer wall is not yet painted, and it is painted after 2 years. What about the borrowing cost for those 2-year period? Charge to P&L account now because your activity is substantially complete. Next is completion of construction in parts. Now this is interesting. Let us say this is an amusement park. Okay, this is an amusement park. It has 4 buildings, A, B, C, D. A and B are ready, opened for public. They are collecting the money from the visitors, and the visitors are happy to enjoy whatever are the fun activities in A and B. These two are not yet ready. What about the borrowing cost? Company have taken a loan of 1000 crore rupees and it has incurred 100 crore rupees as borrowing cost. So first they will apportion this 100 crore over A, B, C, D in the ratio of expenditure. In the ratio of expenditure, whatever is the ratio, these two P&L account and these two they will still capitalize. Okay, but there is a condition that these two are capable of being used independently. Even if the construction continues for the other part, these two should be able to use independently. Okay, so first we'll take a small example on this point. There is a question number 8 below. Is it there, 8 number? Capitalization of borrowing cost on parts cease on completion of the parts. For example, each building is distinct from other building in a business park. The question could arise if the entire building itself is not complete, yet individual floors are complete and ready for use. For example, a high-rise building. In that circumstances, when should capitalization of borrowing cost cease? In a high-rise building also it happens. Few floors are ready and few floors are not yet ready. But what they do, the floors which are ready, they start operating those floors. What about the borrowing cost in this example? So you have to say that as per IAS 23, when the construction of a qualifying asset is completed in parts and completed part is capable of being used while construction continues for other parts, capitalization of borrowing cost in relation of that part should cease when substantially all the activity necessary to prepare for that part is complete, intended for use or sale are complete. And then the concluding line, if individual floors of a large building are substantially complete and are ready for their intended use, capitalization of borrowing cost on those part would cease. Now here one more thing you have to keep in mind. if the other parts cannot be used independently, then you will continue to capitalize the borrowing cost for all the parts. Okay. Now first I'll give you one example to understand. This example will take also after some time. This is a factory and there are three processes involved in this factory. Okay. Output of process 1 will go to B, output of B will go to C, and then C will produce a finished goods. So unless C is ready, even though A and B are ready, they are of no use. Is it right? Now you have taken a loan for the entire factory, which has three processes: ready, ready, not yet ready. But borrowing cost will be capitalized for all three parts. Okay. So now we'll solve one more question. In the notes only we'll solve. To write the answer, I have kept some space blank. Question number 9. A Limited is establishing an integrated steel plant consisting of 4 phases. Phase 1, 2, 3, 4 you will see below. It is over several years. But pending that, phase 1 and phase 2 would be started. Now they have mentioned that phase 1 and phase 2 would be started as soon as they are completed. Following is the detail of the work done on the different phases of the plant during the year. Phase 1, 2, 3, 4. Cash expenditure, plant purchased. Total expenditure. That line you want is important. Total expenditure. And then they have given you the total of all 4 phases, which comes to 2 crore 66 lakh. Okay. And then loan taken, a common loan taken 2 crore 40 lakh at 16%. Assuming this is also the EIR, effective interest rate. Okay. There is no other way to calculate effective interest rate. So whatever is the interest rate, basically use it, solve it. There is an important note below. Current year phase 1 and 2 have become operational. Means you can use them independently. Find out the amount to be capitalized and to be expensed during the year. There is a small error in the problem. What is that error? When did phase 1 and 2 became operational? At the beginning of the year, middle of the year, or end of the year? If you assume end of the year, then there is no calculation involved. Take 16% of 2 crore 40 lakh. You can't simplify it like this, okay? You will assume at the beginning of the year. You will assume at the beginning. So that note is printed below somewhere in your notes. If not, then we will write. So what I'll do, I will first apportion the loan amount in the ratio of expenditure. So write down point number 8, total expenditure. 48 lakh, 75 lakh, 55 lakh, 88 lakh. Anyway you present, final answer must be the correct. And your loan amount is 2 crore 40 lakh. Apportionment of loan amount in the ratio of expenditure. So take on your calculator 48 divided by 266 into 2 crore 48 lakh. So it comes to 43 lakh 30,827. Once again, 75 upon 266 into 2 crore 40 lakh. 67 lakh 66,917. Try again. 55 upon 266 into 2 crore 40 lakh. 49 lakh 62,406. Okay, last one you will answer. Either you write balancing figure or do the calculation. How much is that? 79,39,850. Is it there? And compute interest at the rate of 16% on this amount. Do it yourself first. How much it comes to? Very good. 692,932. This will go to P&L account. Next one, 16%. 10,82,1,707. P&L account. The total of these two I have written in the notes, 17,75,638 plus minus 1 rupee will be charged to P&L account. And these two, 793,985, 1273,76. Add these two. This amount will be still capitalized. That is 20,64,361. Check, is it right? Write a note, I will dictate. It is assumed that phase 1 and phase 2, it is assumed that phase 1 and phase 2 became operational at the beginning of the year. Phase 1 and phase 2 became operational at the beginning of the year. Okay. What if they would have mentioned at the middle of the year? Then half of this would be capitalized. Okay. One more question printed in the cell practice part. Just check. Question number 16. AS Limited borrowed rupees 1500 lakhs at 12% interest for creation of integrated additional plant facilities. So what is the borrowed amount? 1500 at 12%. Okay. So I am going to incur 180 as interest. The expenditure was incurred in a phased manner, each resulting in a specifically identifiable capital asset as under phase 1, phase 2, phase 3. Resulted into creation of asset plant 1 LMN. And under this they have incurred 3 expenditure: machine, building, other utilities. So total expenditure incurred on this is 700, this is 550, this is 850. Okay. If you take the total 700, 550, 850. Note, each of the above plant is a part of a continuous process whereby output of L is transferred to M for further processing and thereafter to N before sale to customer. Plant N includes machinery. Now this is plant N, third one. Includes machinery on which a capital grant of 100 lakh is received from the government. Okay, so this means out of 850, how much is financed by government grant? 100. So how much is the expenditure incurred out of borrowed money? 850 minus 100. Now this one adjustment will keep in mind. If an asset is financed either out of advance money received or out of government grant related to that asset, for the purpose of applying the borrowing cost, we will reduce to the extent it is financed either out of advance money from the customer or out of the grant received with respect to that asset. So while doing the analysis or doing the allocation, the ratio will be 700 is to 550 is to 750. So this interest that we have incurred will be allocated in the ratio of 700, 550 and 750. Okay. Determine the amount to be capitalized in respect of each of the above plants. You would need not allocate the same between machinery, building and other utilities. That later can be done but not required as a part of the answer. Okay. So what you do, first calculate the borrowing cost. So step number 1 is you calculate the borrowing cost. It is 180 lakhs. Is it right? And then you allocate it over plant L, M, N. Allocate. Total will be 700 plus 550 plus 750. 700 plus 550 plus 750 is how much? 2000. So 700 divided by 2000 into 180 is how much? 63 lakh will be a portion to L. Then 550 divided by 2000 into 180. 49.5 will be a portion to M. 750 divided by 2000 into 180. 76 or 67? 67.5. This way the borrowing cost will be capitalized here. Okay. Come back to your main page. Question number 10. Just see, is it question number 10? Yes, seems to be right. In February, a company took a bank loan to be used specifically for the construction of new factory building. The construction was completed in September, underline September, and the building was put to its use immediately thereafter. So when did the activity got over? September. So which means we should capitalize the borrowing cost only up to September. Interest on actual amount used for construction of the building till its completion was 18 lakh. Till September 18 lakh, whereas the total interest payable to the bank on the loan for the period till 31st December amounted to 25 lakh. Can rupees 25 lakh be treated as a part of the cost of the factory building and thus be capitalized? On the plea that the loan was specifically taken for the construction of the factory building. So even though the size of the question is so big, answer is no. We will only capitalize up to rupees 18 lakh. Borrowing cost incurred after the qualifying asset is substantially ready for its intended use should be recognized in statement of profit and loss. Is it right? Will you read the answer as homework? Yes. It is programmed. Now come to disclosures. What are the disclosure requirement as per IAS 23? First is in the notes to account, disclose the accounting policy followed for the treatment of borrowing cost. Second, disclose the amount of borrowing cost capitalized during the period. Okay, and the third is you have to disclose the capitalization rate that is used to determine the amount eligible for capitalization. Accounting policy, amount of borrowing cost capitalized, and the capitalization rate that is used. Okay, now again, if you give right answer, computer will clap for you. So there is a question. First you draw this diagram, and then I'm going to ask you, between this period what is the treatment of borrowing cost? Between this period what is the treatment of borrowing cost? So in that space you first draw this diagram. These are the 7 time periods. Okay, so draw quickly. This in one line gives you a Shortest summary of IAS 23. Ready? So see the note below. T1 is the amount borrowed, but T2 is the activity to make the asset ready for intended use has started. So you will pay interest between T1 and T2. What about that interest? P&L account. Sure. Right answer. T2 to T3. Activity is still in progress. Capitalize. Okay, capitalize. T3 to T4. Unavoidable delay. Unavoidable delay. Capitalize. Capitalize. T4 to T5. Avoidable delay. Suspension of capitalization. P&L account. T5 to T6 activities started again. Capitalize. T7 activity, T6 activity is substantially complete, and then T7 the borrowing was refunded. So you will still pay interest during this period. Treatment. Profit and loss. So this gives you a quick summary of when will you start capitalizing the borrowing cost, when will you not suspend, when will you suspend, and when will you cease to capitalize the borrowing cost. Okay. Now next para 13. Major change in Ind AS 23 vis-a-vis IAS 23. Actually speaking, there is no major difference as such. Only in Ind AS 23, there is one additional paragraph as to how to give the effect of exchange difference. That is what we did in the starting problem. You will calculate what is your exchange loss, how much is the interest saved, and the amount will be transferred to borrowing cost to the extent of interest saved. Remaining exchange difference is treated as a loss for P&L account purpose. Now that paragraph is not there in IAS 23. That paragraph is not there in IAS 23. IAS 23 provides no guidance as to how the adjustment for exchange difference arising from foreign currency borrowing, to the extent they are regarded as an adjustment to interest cost, is to be determined. Ind AS 23 provide guidance in this regard. Okay. Now we'll take one more question for practice purpose, which you will solve in the notebook for a better understanding. Just search for this question. Question number 23. Important. Question 23, very important. We'll write in the notebook. Okay. This type of question you can be asked maybe as a part of a bigger problem also. ASF Limited had the following borrowing during a year in respect of capital expansion. There are three plant PQR. These are the expenditure incurred: 100, 125, 175. Write the rupees in lakh. Here rupees in lakh. And remark, understand, no specific borrowing. So general borrowing was used to finance this asset. Then Q, understand, bank loan of rupees 65 lakh at 10%. Means up to 65 lakh specific borrowing. Whenever there is a specific borrowing, what you will do, from the total expenditure incurred, first deduct the specific borrowing. Remaining amount you will assume is out of general borrowing. And similarly 175 is R, but out of this 9% debenture of 125 lakh were issued. So this Q and R are partly financed by specific borrowing and partly financed by general borrowing. Okay. Whereas P is fully financed out of general borrowing. In addition to the specific borrowing stated above, the company had obtained two term loans from two banks. So this is general borrowing, 100 lakh at 10% from Corporation Bank, 110 lakh at 11.5% from SBI. Determine the amount of borrowing cost to be capitalized in respect of each of the above plants. Ready? We will first calculate the specific borrowing and apportion it to the specific asset only. So write down step 1. Step 1, specific borrowing cost. Specific borrowing cost. Specific borrowing cost. There are two specific borrowing. First is there is a bank loan of 65 lakh at 10%. So write point number 1, bank loan 65 into 10%, 6.5. Right, and 9% debenture, 125 into 9%, multiply 125 into 9%, 11.25. Take the total. Specific borrowing cost will be, is it the what is the total? The total is not required actually, because this will be added to plant Q and this will be added to plant R. So even if you don't take the total, doesn't matter, because the total will not be required anywhere. If you have written the total, well and good. Now write down step 2. First, I need to find out the weighted average borrowing rate. Write down step 2, weighted average borrowing rate. Weighted average borrowing rate. Weighted average borrowing rate. We write two columns, borrowing cost, weighted borrowing. So in this column, we will calculate the cost. In this calculation, we will calculate the weighted borrowing. So it will save our space. So first is Corporation Bank loan. Corporation Bank loan, we have taken 100 lakh into 10%, equal to 10. And it is outstanding for entire 12 months period, right? 100 into 12 by 12. 100. Then write down SBI loan. SBI loan. SBI loan 110 into 11.5%, 12.65, and this is also 110 into 12 by 12. So in other question, the date of loan would have been different, okay? So accordingly, you change the interest calculation here, change the weighted average borrowing here. So my total borrowing cost is 22.65 and my weighted borrowing is 210. So what you do, you write down below, therefore weighted average borrowing rate is 22.65 divided by 210 is 10.79%. Okay, this 10.79% I will use now for capitalization of general borrowing. How many qualifying assets are there? 3, P, Q and R. Out of these 3 assets, 2 are financed by specific borrowing to some extent. So to the extent they are financed out of specific borrowing, first you deduct that. Otherwise there will be double accounting. You're going to capitalize the specific borrowing also, and you're going to capitalize the general borrowing also. So see the answer, general borrowing cost to be capitalized on the screen. General borrowing cost to be capitalized. Draw the 5 columns. Plant, total expenditure, specific borrowing, general borrowing, and borrowing cost at the rate of 10.79%. Okay. Any way you present, if your answer is same, then there is no problem. So now we are going to solve column by column. PQR. Expense is 100, 125, 175. Specific borrowing will be 0, 65, 125. Now understand this column. Out of this total expenditure, we'll assume that specific borrowing is first used for these expenses. Remaining amount we'll assume is funded out of general borrowing. 100, 1650 and multiply by this 10.79%. So it comes to 10.79, 6.475 if you're writing properly, 6.475 and 5.395. So how much is this total coming to? Around 22.66. And how much is your general borrowing cost you have calculated? Let me check. 22.65. And how much you have capitalized? 22.66. So why I asked you to write down, just to tell you, if suppose this number exceeds your actual borrowing cost 22.65, then you have to go one more step. Is it right? And right below, since the borrowing cost to be capitalized, in the exam what you'll do, for the small difference you have to just adjust this two number and make it 65. Okay, but my purpose is different today. If suppose this difference was a big number, what will you do? Then you will first write a note. Since the borrowing cost to be capitalized, write neatly, since the borrowing cost to be capitalized in bracket 22.66 exceeds the actual borrowing cost incurred, in bracket 22.65, revised borrowing cost in bracket general to be capitalized is now what you do, draw this small table, plant calculation and borrowing cost, plant P. This is for understanding what will you do if your calculation exceeds the actual borrowing cost. In this example, it is not material, you can round off the calculation there only, but what if it is a big difference? This way you will present 10.79 divided by 22.66. From where did you get this 10.79? Previous table. Can you see this 10.79? So you have to apportion in this ratio. 10.785 Q 6.475 divided by 22.66 into 22.65. So that will give you 6.471. And then R, same calculation. R 5.395 5.394, total 22.65. This answer is over.